Welcome everyone to another Zoom meeting. I don't know what we're going to call this. We have to come up with a better name for it, fellas. But with Paul Dietrich and Art Hogan, where we get to discuss all the news of the day around finance. Which, man, it just never lets up. There always seems to be something to talk about. So, I guess since our last one, which was only a couple weeks ago, was all inflation. We've got this banking crisis that's sort of on everybody's radar, and it's been a big issue. And Art, I'm going to start with you because I know you were thinking maybe soft landing, maybe not. I want to know, now that we've had this, have you changed your mind at all?
Yeah.
Okay.
That's such a great question. And you know, if anything was going to change your mind, or certainly change the Fed's mind on the path of monetary policy, there's nothing like a little mini bank crisis to do that, right? So, you know, I think that what we're finding out, and it's been 3 weeks since Silicon Valley Bank went under the waves, and what we're finding out is there was some idiosyncratic risk in certain banks that had poor risk management and a high concentration of deposits that were uninsured, that can become very self-fulfilling and unwind pretty rapidly. The good news is we also have a playbook from the Great Financial Crisis that the Feds were able to open up, dust off, and use pretty rapidly to you know, the FDIC and the Treasury capturing Silicon Valley Bank, Signature Bank, and then having a shotgun wedding for them both. It took 3 weeks for Silicon. Signature Bank was over the same weekend. And, you know, I think it's important for us to step back and say, okay, what's changed now? And what's changed is a couple of things. I think we realized we probably didn't have a strong enough regulatory touch for the regional banks. There's 4,200 of them, and we've found a handful of them that likely were, you know, mismanaged, at least on the risk side. But, you know, I think what's going to change from here is that we'll likely have some regulatory changes, bringing back some of that regulatory touch for these banks at some point in time. FDIC insurance probably bumps up from the level it's at, because right now, as a percentage of per capita GDP, it's at one of the lowest levels that we've seen it. So maybe 250 is not the right number. But the good news is the Fed stepped in pretty quickly. And in general, we have a very strong banking system. So I don't think that changes a whole lot, except the attitude by the Fed. And I think the Fed starts to look at this and says, hey, one of the things we've been trying to do with monetary policy is tighten up credit. And this is going to tighten up credit. And I think that this is...
So the failure will do what they were trying to do anyway.
Right.
That's the thinking. Well, Paul, so what worries me also about this is that, you know, and I'm in this business, but I'm not the finance guy with it. But you would have thought short-term treasuries, right? You would have thought, why are these banks, you know, going along putting all that money, and they were told to do that, right? That was part of the regulation. You get this rating if you put this much, you know, cash into the treasuries. They're watching the stuff go down like us, right? Or up and the down. So can't they, you would have thought somebody would have had their hand on the trigger for that stuff.
Yeah, it was a loophole that was taken away during the Trump administration in that basically it allowed banks to mark to maturity their bonds, and with rates going up, as we know, the bonds go down in value, and so they were overstating their capital. And the thing is, what the federal government came in and did and said, look, we'll lend you the money based on the mark to maturity bonds, which we know are good.
Eventually pay, yeah.
So it was a smart move by the Federal Reserve, and I agree with everything that Art said. But I'm more worried about the banking industry in general, because we have this inverted yield curve, and the way banks make money is that they borrow short term and they lend long term. But when you're borrowing short term at a higher rate because the yield curve is inverted, and then you lend it out 30 years for less money than you're paying for it, there's just no way to make money. And what's happening is we're seeing the credit tighten, which is what the Federal Reserve wants. It's, as somebody said, it's like a 50 basis point increase in the Fed rate that they don't have to make because of contracting credit. And we're seeing this everywhere. We're already seeing the contraction coming in. But there's one other time bomb that's in the banking system, and it's commercial real estate. There's, you know,
That's the natural pair with the interest rate stuff, right? Because
yeah,
and the COVID, add that on top of it.
well, and you know, they have long-term loans out to this, and $260 billion has to be refinanced this year, and about $300 billion next year. And what we know is that people are not coming back to work. Most of these buildings are 40% empty. When they go up for renewals, we know they're already basically saying, get rid of one floor. So this is going to be a really tough time for not only banks and lending, and it's the next shoe to drop is commercial real estate. And the real problem is that we're already seeing some owners of buildings coming in and just giving the building back. They can't make any money the way the situation is now, and this is going to be a real problem for REITs as well.
And it's just there's the domino effect is really big with that, Art, too, right? Because you have cities, it's happening in major urban areas, right? I'm assuming they'll probably spread to everywhere, but the taxes are so high there, right? That it's just it's hard to start making a business case as to why you should be going back into it. Do you see commercial real estate as sort of another big problem here?
Yeah, I certainly agree with Paul, and especially as it pertains to commercial real estate on the office side. So if you look at any of the office REITs, they're already down, you know, between 70 and 90% over the course of the last 12 months. So this is not a, you know, a very well kept secret that office is bad. We kind of knew that coming, you know, not knowing how this would play out post pandemic, but you know, the occupancies are back to about, you know, just a little bit more than 50%. From pre-COVID time. So obviously owning office space is going to be an expensive proposition, and there's not much you can do to fix that. The reason it's a slow moving problem, as Paul alluded to, is that the lease terms are longer, right? So, you know, you renew every 5 or 10 years. So we're going to have a slow moving problem, and folks that own these buildings, to Paul's point, you know, just as soon give them back to the bank, and the bank doesn't want them. You know, there is a process that has started in Lower Manhattan where, you know, conversion from office to residential, but that takes so much to do. I mean,
like during the residential thing, which we all remember, you know, you give it back to the bank. It's one of those deals where, hey, if you owe the bank $1 million, they own you, but if you owe $100 million, you own the bank, right? So doesn't the bank come and try to renegotiate things? You give it to them, they give it back. It's sort of a little pushover back and forth.
Yeah, well, I was looking at one particular office in Midtown, probably call it a B, went back to their bank, they owed 200 million on it, and the bank said, how about 70? And the building owner said, no, thank you. So it's the, you know, kind of that situation, but yes, there'll be some negotiations. It is, you know, the next shoe to drop, to Paul's point, likely is commercial real estate, largely focused on office. I think that, you know, the rest of the commercial real estate seems to be doing okay. Industrial seems to be okay. Healthcare is doing okay, but the office REITs are, you know, just a, you know, and well priced in.
Real estate always scares me because that's the thing that happened to us in 2010. You know, there's always so much of our economy is based on trust, right? Not only the banking thing, but, you know, what's perceived value of real estate? What's perceived value of building? Why is this building $250 million? And I put it in Columbia, South Carolina, it's worth, you know, $5 million. So that's scary. So what else might be scary? What would this do? We talk about interest rates. The dollar is still the world's currency. So two things. I'll start with you, Paul, right? So the banking crisis here, is there a global contagion to worry about if that happens, or does this in any way portend we have real enemies now that are ganging up? You got China and Russia. They'd like to see the dollar go down, or would they not? Maybe I don't understand what they're.
Well, we are seeing a global banking crisis. We saw that with Credit Suisse, saw it with Deutsche Bank, and we're going to continue to do this because, you know, again, I think 30% of the loans on most banks' books are in commercial real estate. And what happens, we're assuming, probably given the past, that these are all good loans, and they're not. And we know that. And so what does that do to the banks and making some banks even more in risk of failing? Well, we saw this morning bankruptcies were at the highest level since corporate bankruptcies were at the highest level, I think, since 2011, and we're on course for, we're seeing this, and this is a sign that the economy is slowing. With regard to the reserve currencies, we've seen a whole bunch of countries starting to use other currencies to trade goods that were previously traded with US dollars. We even saw France last week do a big liquefied natural gas deal with China using Chinese yuan currency. We're seeing the Russians trading with the Indians for rupees. For the last 25 years, about 70% of all trade was done in dollars. It's now down to about 59, 60% in 25 years. But that was always possible. The Europeans obviously use the euro to trade between various countries. But in the end, most of the dollar is in dollar-denominated debt. And that's what countries hold as kind of a store of value. And the reason why I believe we're going to continue to be the world's reserve currency for at least all my lifetime is that the dollar is the greatest store of value of any currency in the world. I mean, think about the euro. The euro, if you pay taxes and you're an Italian, you pay it to the Italian government, you don't pay it to the European Central Bank. The only thing that's backing the euro is the vague promise of the Germans and the French to buy up, Greek and Spanish and Italian bonds. And so it depends on how much you trust the Germans and the French as whether you want to have that as a store of value. The Chinese manipulate their currency.
Yeah, I was going to say, if we're trusting the yuan, isn't that bad to start trusting the Chinese at this point? I mean,
Yeah,
it seems like a bad idea.
I think Paul's conclusion. Yeah, I think Paul's conclusion was perfect, right? The reason that the dollar has been the reserve currency for the entirety of all of our lifetimes and will continue to be is just that. It's the faith and trust and the government that's behind that. So who has the largest economy, GDP, who has the largest army, who has the rule of law, and who has fiscal policy that's unified. I think that's, I remember 15, 20 years ago when the euro was coming around, it's like, oh, the euro might someday usurp the dollar as the reserve currency. They have 20 fiscal policies and one monetary policy. It's impossible. It's almost like going back to the great financial crisis and having a bunch of CLOs packed in and then get into a security and saying, okay, this is A-rated because Germany's in here, and underneath that is everything that's not good. So I just, there's a lot of talk about this. It's a recurring story. I just don't think it's anything it's not on the top 20 of things to be concerned about.
When we have these swings, right, especially with bank regulation or with banks failing, you get all this now regulatory talk, right? It was so loose that this seems more like stupidity than anything else to me. I'm just, I'd like to get your take on it. But more regulation always sounds like, well, that's another drag on the economy. I don't care what they say. It's another way to sort of slow things, down. Or, there are people who would love to see businesses more regulated, pay more taxes. I mean, people will try to jump on these bank failures and say we need more regulation. I'm just wondering where you think that's going to play out.
Well, for me, I would say this. And you bring up a good point. I think what's interesting is if you went back to 2010, since the beginning of Dodd-Frank, which had a heavier regulatory touch before some of that was repealed for some of the smaller banks in 2018. Since that point in time, we've seen 500 banks go out of business, fail, right? So 500 banks, we're talking about 3 over the course of the last 3 weeks. So there's a natural course of events that cause banks to go out of business. That we still have 4,200 chartered U.S. banks. I think that the combination, and I think you stated it perfectly, the combination of less regulation got them in trouble, but that was combined or juxtaposed with some pretty terrible risk management, right? And to the extent that fixing both of those is what's going to be needed to get confidence back in the system, in the banking system. I think we're slowly starting to see that. I suspect that over the course of, call it the next quarter or two, probably get some of the regulations that were there up until 2018 back in place, and the FDIC may get to a higher level of what they insure. And I think all of that will be a sigh of relief. But I think, in the here and now, it's easy to focus on, three bad actors that went under the waves. I wouldn't consider Credit Suisse part of this. It just happened in the same week, but Credit Suisse has been a problem for, a decade.
So Paul, you follow the political side of this pretty closely as well. So we're going to go back to highly regulated banks, or is this going to be an excuse, or are people going to kind of see through it? What happens?
I think you have to make a distinction. Having been a former elected legislator, you have to make a distinction in terms of what you mean by regulation. If you're putting handcuffs on companies as to what they can and cannot do, that can slow the economy, that can slow the business, that can have an impact on earnings and things like that. But then there are regulations that are about people being transparent. And given that banks are something that we give our trust to, of putting our money in there, you really want them to be as transparent as possible. And that was the problem with Silicon Valley Bank and probably at least another 140, 150 banks in the US now, is that they had these mark to maturity where you could not tell what the real capital was that was backing the bank. And this is something that I think we need more transparency, and there needs to be more mark to market as opposed to mark to maturity, so that we really know. And the same way with commercial loans, we need to know whether those commercial loans are good or bad, because I don't want to be putting my money into a bank that's shaky and has lots of shaky real estate deals. Now, how do you know that? That's the kind of regulation we need. We need less regulation as to how many forms you fill out for this or that.
And any thoughts on that, Art? Because forms seem to follow regulation like, flies.
Yeah. Well, I would tell you the one thing to remember post-great financial crisis and the rolling out of Dodd-Frank, something that the U.S. banks did a whole lot better than the European banks, and that has proved to be the right thing, is having capital requirements, certainly having stress tests, having living wills, and all of those things speak to transparency, right? And what changed was the size that you had to be in market cap for that to apply. And if you were to just drop that back down to a level that makes sense, instead of 250 billion, make it 100 billion, you'd have transparency across a great majority of the regional bank system. I think all of that makes sense. We're not talking about filling out more forms. We're just talking about making sure you're running your business such that you're going to be around next year and keeping your depositors safe.
So all this stuff happened. We talked about the bank stuff being maybe a 50 basis point, add on there. So what do you think, Art? What happens to inflation now? We started out, a couple of weeks ago, that inflation was the big news. You were oil, right? We're still back in a political conundrum with oil. Is that, we're going to start, that's where people feel it. And that's where they get upset, right? It's in the gas tank and the grocery store. Yeah,
the gas tank in the grocery store. And what's amazing is we still feel about the price of gas today like we felt about it 25 years ago or 10 years ago. And what's always amazing to me is it takes up such a much larger part of our mind share than it does our wallet share. So just to give you an example of that, if you went back to 1990 and said, what percentage of your overall spend, out-of-pocket spend, goes to energy, and it was close to, call it 10%. Now it's close to 3.5 to 4%. But we still talk about it the exact same way. And you could tell me how much you paid for gasoline the last time you went to a gas station. So it takes up a massive amount of our mind share. It's also important when we look at a spike in the price of oil since the OPEC cartel decided to be a cartel again and cut production. We're back to where we were the week that Silicon Valley Bank went under the waves. So we just did a round trip back to exactly where we were. So, we were at or about $82. We got down to $68. We closed the week at $75 before the price spiked back up to $80. We're really not talking about a remarkable new piece of inflationary pressure, especially since most of the hydrocarbon pressure comes from natural gas, and that's collapsed back down to $2. When we think about that input to inflation, that's much more important. It goes into everything.
But Paul, the the price, may be what it is, but it's gonna hurt down the road, and it affects the core CPI. All stuff is up too.
Yeah, my question is how is this going to affect the stock market? Because a lot of this stuff, the Fed can raise rates, but there's a certain amount of sticky inflation, and we're seeing it now in core CPI and core personal consumption expenditures, which is the preferred inflation index for the Federal Reserve. And if you look at a chart of the core CPI, it has gone down, but now it's flattening out. It's going sideways, basically. And then in 2 or 3 months, because it's going to take that long now that the cuts are coming in Russian and Saudi oil, once we start seeing, and a lot of people, I think Goldman Sachs just came out with a $95 per barrel target for Brent crude. Once oil starts going up, we're going to see the CPI and the PCE starting to reverse, and it may not go up very much. But what happens to the stock market the day that we start seeing an increase in inflation, and where people are going to be talking about, okay, instead of 1 more rate increase this year, we may need 2 more rate increases.
So here's what I worry about, Art. So I bought an electric car, and didn't do any research on it, just thought I'd buy an electric car. But it's not really a car. It goes really fast, which is fun. But if I get mad at my wife and I say, I'm going to Atlantic City, I can't do it. It's going to take me like 12 hours. I got to stop on the road, and I got a nice one. I got like all the extra everything. But yeah, I can't go more than 400 miles away from my house. So I'm glad I have it. I can drive it around town and local and stuff like that. But it's not a real car. So we're kind of hitting the thing, and we're telling everybody not to make refine any more gas in this country. I'm just not, I guess it's hard to put together. And that seems like a shoe. That's a big boot that could drop at some point, right?
Well,
I think you're hitting the limit. They're making a lot of electric cars. Is everybody's going to have an experience similar to mine? I mean, it's not, if you're a family and you got 1 electric car, I'm sorry, you're in trouble.
Well, first, I would advise that you not get angry at your wife and drive to Atlantic City. So that doesn't.
If I did, it's not happened yet, but I just want.
That doesn't sound like a great idea at all. So let's take that off.
Well, let me fix that. If my wife gets angry at me and tells me, that's much more likely.
Much more likely.
That's
a higher percentage probability there. Yes, I think that's true for all of us.
Yes.
I would offer up a couple things. First and foremost, yes, electric cars, EVs are increasing, but you know what the percentage is of the vehicles on the road right now in the United States, and what it's projected to be over the course of the next 10 years?
No idea.
5%, and it may grow to 10%. So this is to think that all of a sudden we're naturally going to get rid of internal combustion engines, and they're not going to be around, and then we're going to be impaired by not being able to charge our cars. It's just sort of jumping forward.
So I'm not disagreeing with that. So why are we saying, okay, let's stop refining gas? That seems smart. Let's leave oil and gas in the hands of Venezuela, Iran, Iraq. Let them do all the. That doesn't make a lot of sense to me.
Well, yeah, I think there's a lot to unpack in all of this. I would tell you, our refining capacity is terribly low, and we haven't built a new we haven't brought on new refining capacity in over 30 years.
And why would you? Let's go to the point. Why would you? Because you're going to invest all this money, and then they're going to tell you, you can't refine gas anymore, or we're going to tax you this, and they can't find a business person to go out there and do it.
Yeah. I would tell you that the future of the United States and being energy independent is happening right in front of us right now. And it's the bridge fuel that is going to be natural gas. We have more than anybody does. We have more capacity to turn that into LNG, and we have the ability to ship that to all of our allies and be completely energy independent. So, and I think, the direction of exploration and production is really leaning against natural gas being the future for all of us. Now, again, that's not going to happen, in the next 2 years, but certainly over the next 10 years, you'll be amazed at how much more confident our allies will feel when they can get their natural gas that they need from a friendly source versus an unfriendly source. So I think that's the direction the country's heading in.
We're also moving to natural gas for electrical utilities. So it's actually, we're going from coal and other sources generating electricity, and that is replacing a lot of things. But I don't think we're going to stop. You look at the administration of the Biden administration, and all they talk about is green renewable energy. But you're watching him, encouraging all the big oil producers to pump more gas. So it's a hypocrisy that those of us who live in Washington, D.C., we're so used to it.
Well, someday the emperor will have no clothes. We just gotta wait for that to happen. All right. Well, look, I'm going to end on that, and I feel like we covered a bunch of stuff without getting anybody in trouble, so that's good. And then, look, we can do this again. I'm sure there'll be more to talk about given where we are. So, gentlemen, thank you for your time. Appreciate it. Thanks for helping the advisors out.
Thank you.